everyone, and welcome back to the PetroNerds podcast. This is episode 86 of the PetroNerds podcast, and an incredible two-part special that we're starting today. This is part one. This is a discussion with the director of R&D for Liberty Energy, Roy Aune. This is a really fantastic podcast. I intro this in just a second, so just wanted to start with that. This podcast was recorded on May 25th, 2023. Today is Monday, June 12th, 2023. A lot has happened since then, including the incredible backsliding in oil prices. And I'm going to keep this introduction really short because this is probably one of the best conversations you're going to hear on the state of the frac industry, the evolution of the frac industry, what's going on in the business, and the electric frac fleet, which is all driven by natural gas and the role natural gas plays. But with that being said, today is June 12th. Since this podcast was recorded, we've seen incredible backsliding in oil prices. We're at 67 WTI right now, just at 71 and change for Brent. And that is after OPEC has done a second round of cuts and Saudi Arabia's voluntary cut and adjustment. So what you're not hearing on the market, and it's just incredible. If you flip back between Bloomberg and CNBC, you're going to hear tons of stuff of, are we going into a deep recession? Are we not? Most people are saying we're not now. And the market just keeps going up. All that's really being driven by a handful, 10 to 15 stocks that are way over their skis in terms of their multiples and their valuations. Yes, they have real earnings, but all the price that you're seeing on the stock market is not driven by those earnings. So that's really serious. It does look a lot like the dot-com bubble and dot-com-esqueness that was taking place then. But that being said, the reason we're seeing this this stall out in oil prices is because we keep getting really poor economic data out of China, and there's not much in China from lifting the zero COVID band-aid to really support this. And so we're not seeing big surges in prices of copper or oil or demand for this. And that's usually because China would have to do a stimulus package and they would have to really stimulate the economy, which they have not done. So serious concerns there. And then overall overwhelming concerns globally. There's no economic data point in the globe, in the US, that's saying things are really great. Now, that being said, everyone's confused on the stock market because of these massive tech earnings, but that's not the actual consumer. Now, this week we have inflation data tomorrow that comes out, and then we have retail data that comes out Friday, and later in Wednesday we have the Fed meeting. And the real question is whether the Fed is are they pausing? Are they not having a meeting? Are they doing a hawkish pause? They're probably not increasing, or it sounds like they're not increasing, but then if they pause this meeting, then they'll increase the next meeting. It's a complete mess. They're not telling the market very well what they're doing. We've seen the market sort of bake in higher rate increases. And then the stock market just moves. It takes bad data and says that's good because then we're going to that means that the Fed will slow down or the Fed will cut. And you got to realize that the stock market heals well before your actual recession. And because we have not had a major shoe to drop, we had parts of those shoes dropping in the banking crisis in March, but we haven't had a major shoe drop since, that the stock market really doesn't know what to do and it just wants to rally and pretend this is all over. I think that we're not there yet, and we haven't dealt with commercial real estate. We've got a lot of crises in the pipeline that are probably going to happen. So just to forward you guys on what I have been up to, I was at the Oklahoma Petroleum Alliance annual meeting in Dallas. I know it's not in Oklahoma. It was in Dallas over the weekend. It was awesome. I did some very heavy-hitting podcasts, one with Carl Rove, one with Harold Hamm. Really awesome conversations. I also recorded the presentation I gave, which was exceptionally well received and soup to nuts, state of the industry, everything that's going on. So lots to fill you guys in on, lots of forthcoming podcasts that come from that. My weekend in Dallas, which was just absolutely exceptional. And I think I cannot underscore enough how we're sort of in this very unique lopsided territory of, sort of the market bulls and oil prices really telling us right now that things aren't very good. So, oil prices, yes, are reflecting, volatility in thinking about inflation read tomorrow and the Fed this week, but that is not the only thing they're trading on. They're obviously trading on forward-looking indicators oil is the forward-looking indicator right now for the global economy. So with that being said, really hope you guys enjoy this podcast with Director of R&D with Liberty Energy, Roy Aune. He was a fantastic guest, and it was truly a pleasure to sit down with him. I can't thank him and Liberty enough. This is part one of this podcast special. Part two will be episode 87, which will drop next week. Really look forward to you guys listening to this and can't wait to hear the feedback. Talk to you soon, folks. Bye. Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 85 of the PetroNerds podcast, I believe. If I have the episode number correctly, might have to change that. However, it is Thursday, May 25th, 2023, and I am really pleased to introduce a wonderful guest today, and I'm in Liberty Energy's office. I know it's hard to fix that. I'm in Liberty Energy's office. I'm in Roy's office today, and Roy is known, I think, to many probably in Colorado. He does a lot within this Liberty space, but he's known for the quiet frac fleet. So, without further introduction, Roy, how are you? And thank you so much for coming on the podcast.
Oh well, thanks for having me, Trisha. I really appreciate it. I'm excited to see you again and explore what I think many people find interesting and intriguing about the world of frac fleets and the next generation of frac fleets.
Yeah, so the impetus for this podcast, and so you're Aune, that's how I pronounce your last name, right? Roy, yeah. Aune, you're the what's your title and rough? I know we talked about director of R&D.
Yeah, Director of R&D for Liberty Energy.
Yes, Director of R&D, which is a pretty awesome title and pretty all-encompassing given we're talking about Liberty Energy. And you guys are on the forefront of a lot of technological advances on the frac side. So a precursor and background to this, and I told you this when we were talking offline before, but I had Daniel Siever on the podcast with Fundera Resources, and we were talking about the state of Colorado and emissions and everything, and the House, one of the bills that was 1294, I think that's getting looked at, and we were talking about frac fleets and the lower emissions and the progression, and he referenced this paper actually, and then I really realized this was I didn't want to botch the conversation and just try to talk about it myself. So I truly think most folks, you guys talk about in your earnings call, and there's some references there, but in terms of understanding, what is an electric frac fleet, what's the basic frac technology, where we move from the evolution sort of the frac industry and where are we going, and in your earnings call, you guys talk all about your Digi, suite, basically. It was just Digi Frac, now it's this whole Digi suite, plus the purchase of Siren, and this whole new Liberty, the LPI division, which is all this new gas suite, which has a lot of potential to do all kinds of different things. So there's a lot going on, and I think contextually, as in Chris Wright does a great job in your earnings call talking about the state of the gas market and sort of teeing it up for explaining why the impetus is upon gas right now. So with that, I know we have a lot of ground to cover, and it's going to get very nerdy. So welcome to the PetroNerds podcast, because that's what we do. But to timestamp this briefly, and I'll let Roy go at it. But to timestamp this, WTI is at 71.94. Brent is at 76.25. Henry Hub is getting smashed continually at 229. And Dutch TTF is the real big game changer here. Is the Dutch TTF is below $9. We're sitting at $8.78, which is just amazing to think about. Last August, we were at over $100. So that's how quickly the world changes, especially with natural gas, and the fact how good we are at producing this. And then we have incredible volatility, which oil prices are really reflecting with this debt ceiling debate, which is just an ongoing thing until they come to some agreement. And so the 10-year yield is at 3.23%. We're seeing the 30-year mortgage well above 7%. That's huge. So we're not seeing stocks massively down, but this is definitely having an impact on oil prices. And oil prices are sort of holding that. They're also, Chinese demand is not good. Lots of issues going on within China. That's for another podcast. But with all of that, the state of the frac industry, I think, matters a lot, because in your earnings call, you guys talk about people do ask about the state of the industry, not just the state of the frac side, how many frac fleets are running now, and really pressure on oil prices and where we're sort of at. And I do think it is pretty interesting right now to think about how healthy the industry really seems and feels, especially in terms of activity. As you guys know, I'm sure you're basically sold out, and your phones are ringing for people to get your fleet, and yet we're at $71 oil. So it is a bit of a unique period in terms of, if we look back in previous times when we were at 71, things might have slowed a little bit, and a lot of this is coming on the back of the post-COVID move and wave. So maybe if we can let's just start with the evolution sort of the space of, maybe if you want to talk about the market, I want to talk about quiet frac fleet and the evolution in Colorado, and I definitely want to get into the state and progression of the frac side in the business, but where would you like to begin, Roy?
Wow, there's a lot to go through. No, I'm happy to start wherever you like. Really.
Let's start with the state of the market, because I know that you guys mentioned in your earnings call, Chris said there's roughly 250 frac fleets running. We were talking before about how low was it really at the bottom during COVID, when the depths of despair and minus 37 oil prices and everybody's losing their minds. We were probably in the teens, maybe single digits, maybe 30 frac fleets. The point is, it was very low. So we're at 250 now, and things seem pretty healthy. The industry seems pretty healthy in terms of going, and you guys are adding, and you guys are actively investing, which you typically, Liberty's always done, throughout the cycles, has invested. So with that, you guys have, and maybe we'll go backwards later on the quiet frac fleet in Colorado, but with that, you guys have talked a lot about the Digi frac and the suite and the evolution. And before it was sort of, we heard about electric frac fleets and Digi frac, but now it's the Digi technologies and all these Liberty Power innovations and all the stuff going on in your recent purchase of Siren Energy. So let's start there with just where's the sort of state of where you guys are at, and then we can go back into how you got to how you got here and where you're going from here.
Well, as you said, the demand side is really robust. We're basically, fielding new requests on a daily basis for frac fleets, so that's exciting. It's one of the best, one of the best markets I've seen. So excited about that. On the technology side, what we see is a lot of our customers are really requesting, they want to burn more gas, they want to reduce their costs, they want to reduce emissions. And so that means, the technology that we deploy on these frac sites has to goes from tier 2, we go to tier 4, we go to tier 4 DGB or dual fuel, and now we're moving towards a 100% gas suite. So that's the trend in the market. That's the trend for Liberty. We believe that this Digi suite, or when we talk about a Digi frac suite or a Digi suite, it's all 100% natural gas. So that's really the distinction. We invested quite a bit in dual fuel, and that's been very successful. But going from 70% natural gas, 30% diesel to 100% gas has kind of the dual benefit of reducing emissions and significantly reducing costs. So that's the next phase of our evolution, if you will.
So, and there's a lot to go through and unpack there, and we will. But can you just, on the impetus on the gas side, there's a lot that is super beneficial about using gas for frac and using gas in general for power generation. But I'm curious there seemed to be both a when we think back 2 years ago and where the electric frac fleet state of the business was, there were definitely other public companies that were like, hey, we're not chasing this. We're not going to do it. And clearly that's gone. People are going after electric frac now. But I think part of this podcast I want to do is explaining what exactly the electric frac fleet is, because it's not just, we don't just plug something in and then it's all perfect and it's fine, and we just have power and it's easy. So my question on the gas side is, was the impetus for when operators are sort of requesting this and this is the drive, was it based upon we have field gas, we have gas at low prices, and we have readily available gas, or was it more emissions focused and therefore more on the electric side, or was it just a nice combination of both and the timing is right and it sort of has worked out?
I think in the early days of both dual fuel and electric frac, where we have 100% gas turbines or gas recips, or the early days were definitely turbines. Both of those were searching for a reduced cost frac, because even one of the things that's been pretty consistent is when diesel was down in the $1.25, a couple of years ago, you could buy a diesel equivalent gallon of natural gas for 60 cents, so it was kind of 50% consistently. And as it's gone up, diesel gets up to $4, $3.50, $4 untaxed, and you can still buy natural gas for half that on a diesel equivalent gallon in a can, compressed natural gas. So that has driven, I think, a lot of the demand. They look at that and they go, it's kind of a win-win. We've got in West Texas, there's several places that can supply field gas. So with a light treatment of that gas, you can run it straight out of the pipe. And
that's pretty amazing.
Yeah, so they see that, we can reduce flaring, we can reduce the load on the pipeline. So that's the best, if we can just plug into a pipe. Unfortunately, there's not always that possibility. Right. So thus our investment in LPI and our investment in Siren, to help deliver that gas to our frac fleet.
Well, and I have to speak about this great paper. So if you're wanting to understand sort of the business right now, I would say listen to the latest Liberty earnings call, and also read this great paper that you did with Chris and Madison Holloway. You guys call this a white paper. And this is, so it's called the evaluation of the next generation of fracturing fleets, Tier 4 diesel, Tier 4 dual fuel, and electric. And it does a really good job of explaining a bit of the state of the industry, but really the competing challenges, and most are positive, but how electric stacks up to electric primarily driven from gas stacks up to a Tier 4 diesel, or dual fuel, a Tier 4 dual fuel, and how those stack up on an emission standpoint and fuel use. And you guys even get into the costs. But there's some stuff in there about, the as a nerd and somebody who thinks about markets and, and a strategist, I always worry about what can go wrong. And you even say it in here it's the supply chain, right? Making sure you have that critical access to supplies it's great in the dual fuel because, when something's now, if you don't have gas, you're running diesel or vice versa. If you're on the electric and you're running gas, you need to have all that gas right. And that field gas, you guys kind of specify. I mean, we know it's not perfectly clean. You have to compress gas. It has to be clean. If it has H2S, the BTU content, I mean, not all gas is created equal. So there does seem to be, there's some variability there that obviously I'm guessing that Siren and these things that you're investing in, part of that's why you're doing that is because if we could all just get direct field gas and it was perfect, we wouldn't need any of these other solutions.
Yeah, there's a lot of lessons learned. I would say that the pioneers in using field gas, we've all we've learned so many lessons on, there's liquids in the line. You need to make sure that you have catchers to remove the liquids, dehighs. There's so many lessons, around H2S, around everything you said. The BTU value really matters. Most of these engines are not tolerant of high BTU gas.
Oh, so they need lower.
Yeah.
Okay.
Absolutely.
Okay.
Yeah.
Okay.
So we typically has to be, if we use a BTU basis, probably around 1050, could be 1100 BTU gas, and what comes out of the ground and most of the places we frac is 1250, 1300.
Okay. So it's too high.
Yeah.
Yeah.
So by and large, we this is pretty straightforward. Most often we refrigerate it. We can use, if it's only a little bit too high, we can use other methods. But if you take it down to about -50, most of the ethane drops out.
Okay.
And then the good news is these days that ethane has value.
Yep.
There was a time not that long ago
where
we
were rejecting like 1 million barrels a day of that.
You were paying people to take it
Yep.
away. So yeah, that's
so it's solvable.
All of this is solvable, and we've solved virtually all of it, right? And so the really what we do today is if we can get gas out of a pipe nearby, that's first prize, right? Let's take it out of there. Let's treat it. There's certainly some fleets that we have active and are coming up that will be doing just that. Everywhere else, it's actually awesome just to get get the gas, compress it, put it in a can, bring it over. Still, you get such a savings, and it's easy.
Yeah, and so to me that makes complete sense to me, regardless of whether you're predominantly fracking with Tier 4 dual fuel or you are fracking with Digi or completely electric. That investment in actually having gas infrastructure, and it's the way Chris describes it is great because it's how I think of it. It's sort of pre-pipeline. It's like a pipeline, but it's the supply chain and logistics of gas that you need to make sure you have it. Just like you need to make sure you have diesel. And you and I were talking about that offline, and I think it's important to think about of the state of the diesel market. And if you guys go to Pittsburgh or you go to the East Coast, or even here in Colorado, when Suncor goes out for a few days, you see these big spreads in gasoline and diesel prices, and so that obviously impacts the business. And so when we haven't seen diesel prices come down commensurate with gasoline prices, this is it's a driver to have natural gas and having the reliability. I mean, the whole deal with frac, and I'm not sure everyone in the world understands this, but you don't want any downtime. So you want to be fracking 24/7 and every minute, as many minutes as you can in those 24 hours. And so having all your logistics, everything lined up in a row, and making sure you aren't waiting on water or sand or fuel and chemicals and all the million other things, that's pretty critical.
Yeah, as you mentioned, when we're primarily running dual fuel as our gas consuming fleets, the great fallback on dual fuel is, as you mentioned, when you lose natural gas, it just switches over to diesel. It's seamless. There's no hiccup, and it's you just you frack on.
Right.
But when you have 100% gas fleets, obviously when you lose gas, they die, and we can't have that. Like, we have to be in control, to the extent possible, ensure that we're not going to run out of gas, and that one way to do that is to take it on yourself and just accept that reliability issue and do it yourself.
Yeah, and so this might be a good point to sort of break this out and start talking about. And if you can't answer this, that's totally fine. What is the state of your guys' frac fleet? How much is? This allows us to get into the Digi suites, and because you talk in the earnings call about a couple case that are like starting it, and then there's going to be another rollout. I think this next quarter. But how much of it is it predominantly Tier 4 dual fuel, and then you're adding in the electrics now?
So if you looked at I would say roughly a third of our fleets are dual fuel fleets.
Okay.
I don't know if I'd get exactly the ratio of Tier 4 to Tier 2, but
okay.
We have about a third of the fleets running on dual fuel and 2/3 on diesel.
Okay. And can you just, so we can break, I really want people to understand, we've got Tier 2, Tier 4 dual fuel, and this new electric that varying companies are doing. Is that roughly, am I categorizing if we're thinking of simplifying what the frac fleets in the, fracking right now, is that the three main frac fleets?
Yeah, you really have Tier 2, you have Tier 2 dual fuel. It was kind of the first iteration of dual fuel. And then we went to Tier 4 diesel. About a year later, the Tier 4 dual fuel became available, and we quickly adopted that and retrofitted all of our old Tier 4 fleets into dual fuel fleets, and now moving into 100% natural gas using reciprocating gas engines.
Okay, so can you help explain to folks what is, because I'm guessing not every company is Liberty Energy, so there's got to be a decent amount of those Tier 2s, probably original Tier 2s, which I'm sure are working through the system of getting, renovated and updated or whatever, but Tier 2s, Tier 2 dual fuels, and then the Tier 4 and Tier 4 dual fuels, assuming those are all still, we have variations of those still running. Can you explain, simplistically, what those are and the differences? Because I don't think most people understand that. And this paper is great on explaining the couple of those, but not the older versions.
Yeah, I would say the majority of the fleets out running today are going to be Tier 2 diesel.
Okay.
There's certainly a decent portion of some portion of those were upfitted or converted to Tier 2 dual fuel, and we bought a number of Tier 2 dual fuel new fleets. And so the switch from Tier 2 to Tier 2 dual fuel really was, we went from an engine that would consume, let's say on average, 100% diesel to on average something like 50-50.
Okay.
So when we went to Tier 4, EPA drove all these tier levels. I don't know how much you understand about that.
I mean, well, I don't think most people do. So, we don't have to get too in the weeds, but I think that's a concept of, what is a Tier 2 versus a Tier 4, and that's, we were talking about before, is an EPA-driven standard, but what it actually, if you can explain what it actually resulted in, would be great.
Yeah, so in the early 90s, the EPA promulgated a rule that said we are going to reduce the amount of particulates and NOx from diesel engines. Particulates, of course, were causing a lot of smog and NOx. So Tier 1, Tier 2, Tier 3, and Tier 4, these kind of landed in the early 2000s, then late 2000s, like 2011, 12 or something was Tier 3 that only affected smaller horsepower range, and then for the large horsepower, 2017, we had to be over to Tier 4. But at the progression, really the last few years from Tier 2 to Tier 4, we significantly reduced the amount of particulates. I think it's, 10 times less particulates and 10 times less NOx going into a Tier 4. And it's dramatic reduction, 100x or something like that from Tier 0 to Tier 1.
Did also the actual fuel use and efficiency increase as well? I mean,
so that's where we kind of, these were rules put in place to reduce NOx and particulates. The efficiency in the early days, when we went from Tier 0 to Tier 1 to Tier 2, we saw some efficiency gains for sure. But the technology that we had to employ, or not, when I say we, I mean the engine manufacturers, that collectively spent billions on this technology. And it was a massive undertaking, especially the Tier 2 to Tier 4. Yep. They would gain efficiency, but then because of the exhaust gas recirculation or the turbo or the things we had to do to reduce the pressures in the cylinder to reduce NOx, we'd gain the efficiency and we'd lose it again. So really the efficiency from a fuel usage or a carbon intensive standpoint, when we went from Tier 2 to Tier 4, was no change. They virtually used the same amount of fuel, but they put out dramatically less NOx in particular.
Right. It reminds me a lot of and NOx for folks. I don't know if we meant nitrous oxides. We have very high standards and have in the U.S. for very low NOx. I mean, we have some of the lowest NOx and SOx, sulfur dioxide emissions in the world because of our emission standards. And it reminds me a lot of the refining industry. If you spend time with refiners, I mean, they had to reduce those. I mean, they had massive changes of really making refineries a lot cleaner in their emissions output for NOx and SOx. Probably other things I'm getting wrong. But I know it was the ppm, it was the parts per million. And I remember, if you get a refinery guy to walk you through, it's that the big chunks were pretty easy. They worked on that, got the big chunks, and then it's really reducing at the bottom end that getting the parts per million down as low as they can. That gets really harder, and it requires significant investment. And the problem is that they're doing it and they did it, but it costs a lot and you don't get a return on it. And so all these standards, and not saying that we shouldn't be doing this to make things cleaner, but the cost component is really, really huge. And so having clean, really, I mean, we just had a couple of years ago, lower sulfur and diesel standards, and I mean, that matters a lot, but it's also, there's huge costs. It's the reason why I know you don't build a refinery every day. I mean, there's permitting issues with that, but it's also because there's massive cost implications and you have to get a return, and refiners are kind of a thin margin business. So it's one of those things that's I think a lot of folks probably don't understand, that you aren't getting a material, you're not using less, but still, regardless of that, the industry, the frac industry, and I'm guessing also the operators, are pushing the industry to flip to be moving toward, at the very least, to Tier 4 dual fuel or Tier 4, so that they can also be showing their lower CO2 emissions on their end.
Yeah, absolutely. And so just to give you an idea of the cost implications we're talking about. So we talk about, we went from Tier 2 to Tier 4 engines. That was probably about a 50% increase in the cost of an engine. And so it's extremely meaningful. We're talking about an engine that was $350,000 and it went overnight to $550,000 or something like that. So
that's huge.
The cost to go to Tier 4 was massive. Well, I don't think anybody, because of the complexity of these Tier 4 engines, thought that they were going to be cheaper to operate, and we were right about that. So we got the increased cost of the engine, and we also got increased maintenance. Give you an idea, I think you can understand the kind of generally where this puts you, but in Tier 0, kind of late 80s, early 90s, the injection pressures, so the pressure we pressure that fuel up to, and then we push it through the injector into the cylinder, we were injecting at maybe 150 psi. These were big nozzles. We had a common rail system. We just pressured up to about 150, and we'd squirt it out. And it kind of would be some liquid, and some would be atomized. On a Tier 4, that's gone to 35,000 psi. And so we have individual pumps.
That's a massive change.
Yeah. The size of the injectors, and so the injectors wear out faster because
a lot more things can go wrong.
Yeah, everything can go wrong with these. And so the investment to make these improvements, happy to do it, but it's not small. And as we move into gas engines, it's another step change. You're talking about another 50% increase in the cost of these engines. And
we're not even talking about the added layers and components of also the evolution and state of frac, which went from, a lot less fluid and a lot less sand or proppant being pumped to a lot more. And so that's just the engine, but we also have a lot of wear and tear on the machinery from pumping this very fine mesh, 100 mesh sand, that it's different than it was you're pumping more and you're pumping a finer grain. So that's the evolution in the state of the business, and that changes. You add all that stuff and you compound it, and then it sounds like you have a lot of equipment maintenance and stuff that you have to that's a continually thing to work on, and you can't have downtime. So this is something that it's really impressive to me to just think about all of that everything's got to be working and humming just right. And I know I've been to your guys's your field office out here where you're working on the trucks and everything, and this is a constant that you have to be keeping this stuff fine-tuned, but I'm not sure that the average folks appreciate that level of both sides are constant maintenance on this equipment.
And it's constant maintenance, and like you mentioned, the amount of hours that we frac daily. 10 years ago, it was 9-10 hours a day, and now we have crews daily that frac 24 hours. And when do you get the chance to pull that equipment out and work on it? And so there's an expectation of a higher availability for all that equipment. At the same time, you don't have access to the equipment so you have the planning required and the technical ability of the maintenance departments and crews these days. It just continues to amaze me, even that they can keep these things going as well as they do, especially as the complexity just ramps up with these engines every stage. Yeah, no,
it's a really good point. I think people they underestimate supply chain logistics, and I mean supply chain in more than just sand and equipment, but the whole putting this stuff together and allocating maintenance time. So we've sort of walked through the evolution of where we're moving toward, and we still have older frac fleets and running, but pushing on the Tier 4s, and that's obviously there does seem to me huge benefits in reading this paper of the Tier 4 dual fuel, meaning that because you have a dual fuel, you can use it. You have the benefits of running the gas, on an emission standpoint, it's pretty competitive, it sounds like, from a CO2 perspective of reducing CO2 emissions. And also, it doesn't have the same, and this is, we can get into what the Digi side and the electric side is and how it's actually run from a gas perspective. But the dual fuel sounds, I'm inclined toward it in so many ways because like you described, when one's not working, if I don't have enough gas, I can run the diesel, and the fact that it's instantaneous, and also so if you're not idling, and the idle time is a mess. So it does seem to be the ramp up and the ramp down. From my understanding, seems a little easier, and so there's efficiencies with that and savings with that, and I think the maintenance side, there probably lots of efficiencies and lots of cost savings, especially if you're using 100% gas on the electric side, but there's also maintenance issues with that and upfront costs. So I'm saying a lot there. Is that an accurate description, and can you maybe help me understand that better and break that down for listeners of, what are these dual fuel benefits really do seem to me have these positives, but then that will allow us to get into this EFRAC conversation.
So the dual fuel does have a lot of advantages, and most of them are centered around cost savings, right? It's reduction in diesel burn, and it's not a small thing. With Tier 4 dual fuel, you can hit that 70% plus across the pad.
70% gas.
70% gas. Yeah. 30% diesel.
Yeah, which is great.
Which it's a big improvement over 50-50 with Tier 2. And so happy to see that. Like you talked about, it's awesome because if for some reason you have a gas interruption or a gas problem, you just frack on diesel, and that's great. They are, I guess the downside to those engines is they are incredibly complex and they are high maintenance. To keep a dual fuel fleet running on gas continuously requires a lot more attention.
Okay.
We quite often will have an extra technician on site just to work on the dual fuel side of that engine. And so that's maybe the downside for the operator, or for us, is that we have to put additional resources into maintaining that, and maintaining, again, like we talked about, trying to maintain these systems in real time when we're trying to do 24 hours of pump time a day. It's really challenging.
So you mentioned, this paper mentioned something about screen outs, and I think it was with regards to if you didn't have the fuel, right? If you didn't have the fuel, but there was something to talk about with the electric side, and I'm not sure if I'm doing a good job of rounding the circle or squaring the circle on these topics, but so you have to have a lot of maintenance. They talk about in this paper as well, again, worth reading, of having extra technician stuff on the dual fuel. So on then the impetus and the push then. So tell me the impetus and push on the whole Digi suite of, you guys have obviously are doing it. And this is a step change from Tier 4 dual fuel. But it's not, I think when people think of an electric frac fleet, they're literally thinking electric. And I'm not saying that people necessarily close to the industry, but a lot of folks, and maybe even some Wall Street analysts, may be thinking, electric, great. So let's talk about what is it, and why did you guys lean into it?
Yeah, so the early electric fleets were, and I'll back up. So to be sure, these electric fleets don't just plug in to the grid. We talk about how much power a frac fleet needs, and it varies, but for the most part, we could probably say 25 to 30 megawatts of power is when we're up and fracking. That's the kind of power that we need to draw, or we do draw from our pumps. Now, that megawatt roughly would supply 1,000 homes worth of power. So if you think about, I need to power up this frac fleet, suddenly there was in a place, maybe in West Texas or in far afield. If for those of you that have been in West Texas, it's pretty remote, and so the the grid really isn't very robust there. A lot of the lines are kind of 35,000 volt lines. They're not really designed to take this kind of power. But if you imagine just a town of 25,000 people popping up there, and now we need all that power
all at once
for about 2 weeks, and then we don't need it anymore. Now we need it over here. And so it's not really, it's probably technically feasible to plug into the grid in certain places on the grid, but
I think the description of that the way you break down the megawatts is great, because I think a lot of people, with the push on the energy transition and ESG stuff, it is that we just have to electrify. So one would be, depends on what your grid is, so it would be green, but the power you need for frac is so different from just drilling and the ability to just plug in. And you even hear of a lot of folks now talking about the lack of electricity availability in the field, not for frac, but for just for production, and the need for more electricity in the field. So that's already a thing. So and folks that are, a lot of folks who listen to this podcast are in the industry. So, but if you have not been out to Midland or North Dakota or grew up around the oil field, it is really pretty, it's usually in remote places, it's spread out, and this, you don't have, you just don't have this power generation capacity readily available. So it's also why, if you're smart and thinking, oh, it makes sense to invest in this stuff, it does, because you just don't have it readily available. And if we are thinking we're going to have grid issues, it makes super sense to me to be investing in things that could provide you with that. So I think that's a great backdrop of 30 to 35 megawatts, you're saying?
25 to 30
25 to
megawatts,
30.
yeah.
Well, how does that compare to on the drilling side? What is required on the drilling side?
I think there's a lot of drillers that have been able to use electric rigs here and actually pull off the grid in the DJ Basin and elsewhere. And I think they plan for about 3 megawatts, but they probably use about 2 or maybe a little bit more than 2.
Okay, so it's significant. I just want to make sure listeners understand significantly. We're talking
it's
1 to 3.
Yeah,
exactly.
Yeah,
it's a fraction of it. So very different. Okay, sorry. So continue.
Well, so because you can't plug into the grid and pull just 25 megawatts off everywhere, you have to bring your power with you. And so the first generation of electric, by and large, brought large turbines to generate their own electricity, and these were natural gas powered turbines, and they would put out anywhere from 6 to 35 megawatts each. So in some cases you just need one big turbine to power an entire site. Sometimes you would do a number of small turbines to power the site. So you bring that was like Gen 1. And it's pretty effective. I mean, these turbines, they run on a wide variety of gases, so they don't require a lot of treatment. They're not terribly bothered by H2S, and so it was kind of a great. It was
pretty resilient.
Yeah. It was nice. The problem is they're relative to natural gas reciprocating engines. They're pretty inefficient.
Okay.
And so you have kind of two problems there. They use a lot more gas, and so it costs more money, and then it also increases the carbon footprint if you're.
So it sounds like they're slightly more resilient, but they're using a lot more, so the inefficiency is big. Do they work? And you kind of mentioned this in here, and I wanted to. Does it work similarly to maybe this isn't Gen 1, but a natural gas power plant? Is that how we should be thinking, like folks can think about it? Is this similar process or not?
It's, sometimes they use the very same turbines that they use, and sometimes they use these in power plants for peak shaving. If you can spin up a turbine quickly in areas of peak demand where we just need an extra 40, 50 megawatts for the peak hour usages, and then just shut them back down. That's exactly where they would use these types of turbines in a power plant. Okay,
but that was Gen 1?
Yeah, so we looked hard at that, and we had already published this paper, and we felt like, it was kind of going...
When was that? Sorry, just for time stamping that?
So the original paper, I think, was back in 2017, 2018.
Okay.
And then we updated it here a little over a year ago.
Okay.
So so we kind of looked at the turbines and felt like it's a single point of failure in many cases. If your turbine goes down,
Right.
your whole fleet goes down, and turbines were long lead and they're hard to fix, and they're resilient, and they do tend to run for forever. I mean, these are long-lived assets, but we just didn't feel confident that was where we wanted to go. And so we continued to invest in dual fuel. We felt like, hey, this gets us a lower carbon footprint. It gets us lower fuel usage. It gets us most of the way there with Tier 4 dual fuel. We're using 70% gas, and it's if we have any gas interruptions, frac on. And like you pointed out, that's the name of our game. We're here to frac.
Right.
So a couple of years ago, we started looking into, well, what could be the future. It was probably 4 or 5 years ago now, and the electric. If you generate the power with natural gas reciprocating engines, you kind of get the best of both worlds. You get very high efficiency, even much higher than you would get with diesel, and you get kind of a more distributed power on the pad, where you have maybe 10 or 12 gensets running. If one gets shut down, you just turn up the other 11 a little bit, right? So you have this natural backup, and that was really important to our operations guys. Like, they did not want to have, they hate having a single point of failure anywhere in the system, and it was very intimidating for them to say, well, we're going to have, if we had one big turbine that went down, that's a problem. So so we said, okay, well, maybe this has legs. Let's look at what we could invest in on the natural gas reciprocating generator side to match up with our electric pumps. So that's the direction we started moving 3-4 years ago.
And that's when, so that's the direction you started moving. That's when we first saw the launch. I believe the launch of the DigiFrac was about 2 years ago, right? Where you guys had it, you were displaying it here downtown Denver, Investor Day. You might have talked about it before then, but this was, June of 2021.
I think you're spot on. I think that's when we had it.
So that's the spurring. So where are we from then, and where you just talked about where are we at now with this, suite of, what Chris talks about in the earnings, so this suite of Digi technologies and all these, Digi hybrid Digi Prime, which was, he said, was announced at the SPE conference, at the Hydraulic Fracturing Technology Conference. I'm slightly lost in terms of, I mean, I know what these things are, but I would love for you, because we've talked about it, but if you could walk through from June of 2021 on your Investor Day to now on these suite, where's the movement, where are we thinking, and what is a hybrid Digi Prime?
Yeah, so June of 2021.
Also reminds me of Transformers.
Yes, there you go. Digi,
Optimus Prime, and
there you go. June of 21, we had our Investor Day, and we had a quintuplex. It was really our proof of concept first DigiFrac pump, and we took it out. We ran it on diesel generation, and just prove out the concept that this could work. And it's a departure from conventional electric. So most of the electric frac pumps out there have a single big motor hooked onto a pump. Our technology, again, wanting to have kind of redundancy in the system, has 10 electric motors hooked to each pump. So if one electric motor fails, well, we'll turn the other 9 up a little bit. And that was, one of the important features we saw of the technology that we developed. So over the last couple of years, we've commercialized that pump. We've invested in natural gas reciprocating gen sets, and that transition is, I think, kind of interesting, because these are engines that were only approved for basically fixed stationary. They were approved for power generation, they were approved
Right.
for gas compression, but they weren't approved for non-road mobile.
Right.
And so part of this evolution was getting these engines in to be EPA certified for a non-road mobile application. And it's no small task either.
Absolutely.
It's millions of dollars to do these tests, and the EPA is, they spend a lot of time making sure that what you put out there is meeting the standards that they set out. So that was a hurdle. We've kind of overcome, both of those hurdles, and now we have fleets out there. We have one fleet in West Texas running that is, well, it's just that we're generating power on site using gas reciprocating engines, and we're consuming it with our electric motors. And so
That's awesome.